Greetings all, Ben here, East West. Been away for a few weeks, but going to jump back in and have a bit of a look at uranium this week. So let's get straight into it. So just quickly, I wanted to start off this week by just having a think about the difference between long-term investing and short-term price action and market structure. Now, in my opinion only, if you are a long-term investor, then I don't believe that you should be going below the weekly time frame on any chart that you might look at. And in fact, I probably wouldn't check my stock portfolio more than once a week. Maybe even once a month is enough. And if I was a long-term investor, how would I set my charts up? Well, the first thing I'd do is just look at this on a weekly, and all I would be doing is just marking off the previous points of interest. Okay, so I would have just done this. Now, this one's obviously been broken, so you could get rid of that. But I would just have those marked, just as a point of interest. And then the only other thing I would do, look, personally for me, I would use an Ichimoku cloud. So if I just widen this out, I would just bring in the cloud. And then all I'd be looking for is a couple of things. All I'd be looking for is the possibility of a Kumo twist, which basically means that the leading span A will get below leading span B, which forces the cloud red, and that would only happen because price is sagging, and that would be a warning sign that price is approaching the cloud, which is also what I'd be looking for. And then I'd just be watching this Chiku span, this lagging span, and just to see if it gets on the other side of the candles. Other forewarnings would be the Tenkan-sen, the faster moving line, getting below the Kaizen-sen, the slower moving line. But that's it. I wouldn't be doing anything else unless one of those three sort of things or four things happen. That's it. You don't do anything else. You don't look at anything else. They're just your pre-warning signs to have a think about your position. That's not happening. So there's no need to think about it. Don't think about anything else other than that. You don't have to think about any sort of other technical picture other than those factors. Okay, in my opinion. If you do, you're doing yourself a disservice, I believe. But you may not like the idea of the Ichimoku cloud. You may not understand it. It's too messy. You don't like it. I think you can still just keep it very simple and very clean. I would simply just have this trend line on my chart like this. That's it. That's the main trend line. I don't think you need to do anything more than that. The only other thing I'd probably suggest is maybe, because this is a good trend, you can see the swings in the trend. I would probably be inclined to sort of, maybe not off that pivot, I'd probably be more inclined to keep this trend line there. But I wouldn't do anything other than that. If you go down the time frames and start fiddling around with, this is a bullish close, this is a bearish close, this is a hammer, this is a star, but I'm a long-term investor. I think you're kidding yourself. Like, if you're a long-term investor, anything under the weekly time frame or even monthly time frame is not relevant to you. And if you are down there fiddling around in that, then what are you doing? In my opinion, I don't think you need to. That's not your horizon. So what I'm saying is the problem with fiddling around down on the lower time frames is you might start seeing shadows that might make you sort of jump or affect your psychology if you are in fact a long-term investor. So that might sound counterintuitive, because basically what I'm saying is that if this is you, then I don't think my videos have got much benefit for you. There's probably no point in looking at them. But if you're scouring YouTube or the internet or Twitter, X or Twitter or whatever, looking for confirmation that your long-term view is right, on a daily or weekly basis, well, what are you doing? Like, you either believe in your position or you don't. If you believe in it, then why are you seeking confirmation? If you don't believe in it, well, are you really a long-term investor? Because you're not going to be holding it. So anyway, look, they're questions for you to answer. But I think the point remains that if you are a long-term investor, don't fiddle around underneath the hood. Like, I like doing it. That's me. I'm a short-term guy. I'm a short-term trader with long-term views. Okay, that's just what I've done my whole career, and I'm interested in the price structures underneath the market. And it's like a car, right? I mean, if you're a long-term investor, you just want to get in and drive the car. But for me, I like getting under the hood with the wrench and the spanner and seeing how it all goes together, because I find it interesting. And if you do too, look, you can still be a long-term investor and have interesting price structure, but just make sure that the interest in the price structure isn't being dictated to you because you're unsure about your position. Let's say it like that. Okay, I think I've said enough about that, so let's move on. Now, the next thing I wanted to talk about are gaps in the market, because a few of them have popped up lately, and I've seen some people say, I don't believe in gaps, I don't think they mean anything, they're rubbish. Some people think that they, getting filled in is a good sign. So whether or not you think it's relevant or not, well, that's up to you. I'm not trying to change your mind. But for me, when I look from the outside, and from the overview of people arguing about whether or not gaps are relevant, or if there's something to pay attention to or not, I just look at it and think, well, hey, hang on, I can quantify a gap. It's quantifiable, therefore it's testable. And if it's testable, then we can drag statistics out of it. Now, before I go any further, let me just throw a couple of quick disclaimers at you. I am not a trained statistician. I am also not a trained data scientist, and I am not a trained coder or programmer. Everything I've done, I've sort of learned how to do it myself. Therefore, you should probably take what I say with a grain of salt, because your knowledge of this subject may be far superior to mine. And if it is, well then, let me know. Great. I'd love to hear anything you've got to say. But however, as far as I can see, there's no reason for me to think that what I'm going to present is incorrect. Maybe some of you think it is, that's fine. But I think that's just basically a disclaimer, okay? There's no sort of, there's no advice being offered here. This is just my own observations. I've done my own research, and this is my own research. So if this is something that interests you, and you think there's more in it, and you want to look deeper, then do your own research, okay? So to quantify a gap, and some of you might even do this differently, I've just quantified a gap. I've defined a gap as a day where the low is higher than the previous day's high. That to me is a gap, okay? Now, the closing of a gap, I've just simply said when the low of a day is equal to or lower than the high of the gap. So some people might only consider a gap closed when in a bullish gap like this, that a gap might be closed when the close is lower than the gap. I guess you could do it that way, and that would certainly alter the statistics. So if you're a permeable and you don't want to hear anything that might go against your own strictly held beliefs that you're right, then you would certainly say that a gap is only closed when the low when the close is lower than the gap, because that way there would be a lot less gaps filled. That's how I'd look at it. However, any way you look at it, like I said, this is just how I've done it. And so I just did this all in code. I just wrote all this code out just to test my ideas. Okay. Now, I didn't consider bearish gaps, because obviously if a market's trading at or close to all-time highs, there's no bearish gaps. And guess what? Every single bearish gap in the uranium space has effectively been closed. There are none. But I think we're interested in the bullish gaps, right? So I think the question I was going to pose is, do bullish gaps get closed? Now, just to be fair, I've only taken data from the start of basically the rally. So in everything I tested, I've started at the start of 2020, right? So I don't think there's any bullish gaps in here, but that means we can see what the behavior of the gaps have been like through this whole rally. Because the problem is, when you look back at this over time, the fact that the market came all the way back down to here, right, down to this point, which is pretty low, means that, of course, any let me just take this back, right? If we take it back to here, that means that any bullish gap between here and here was closed, okay, as by what I've done. So whether or not that's fair, well, what you find out is that 90% of gaps close if you take it like this. But I thought that was a bit unfair. I just wanted to see what was happening through here. That's what I was more interested in. And this is what I found. URA has had 76 gaps, and 90% of those are closed, and 10% of them remain unfilled. Okay, so there are open gaps in the market, but if you look at these, okay, here's another grain of salt moment. In terms of stats, as far as I understand, and as far as I've disclosed that I'm not a trained statistician or data scientist, a lot of these I would consider very small sample sizes, which means that I would think that a lot of these are where's is the relevance really there? Because the sample sizes are very, especially like Denison, like 13. There's only been 13 gaps. 80% of them are closed. Well, 76% of them are closed. 23% remain open. Okay, so the sample sizes are quite small. I mean, maybe URM with 95 gaps, and nearly 80% of them are closed. Maybe that sample size is getting a little bit better, but I would definitely say that a lot of these sample sizes are maybe it's very fair to say they're too small to be relevant. Nonetheless, I thought I'd do it anyway. And this is what I found. I mean, that's just what my coding brought back to me. So all I would say is that, okay, this is not the gospel. It's not the Bible. Is it something we can lean into? Well, I'd say there is definitely an angle, because what this suggests, of course, is that gaps close a lot more often than not, or they have in the last 4 years. Okay, you can see that, like, that's just that's not me guessing or believing. That's just pure stats. That's the numbers. I've just worked them out. That's how often they close. All right. So this probably ties back more into the short-term trading versus the long-term investing. If you're a long-term investor, this is completely irrelevant to you. Gaps do not matter. Okay, nothing matters except those trend lines. Like I said, the rest of this is just interest. Okay. Now, if you're short-term trading, I think there's something here that you can lean into. Okay, knowing that gaps close. So, with that being said, I'll finish up my gap rant here, and we'll move on and just take a bit of a look at the charts. So let's just start with CCJ here. And, this is the same chart that I showed at the start. If you're a long-term guy, you don't need to know anything more than this. Everything still looks pretty good, okay? The trends are all still in place. And we know that we've got a zone up here towards the all-time. This is the all-time high. This was the previous peak. So this is the zone of interest that still remains a little bit short of where we are, but it's laying there, okay? So we know that that's in place. In terms of the cloud, like I said before, everything still looks pretty good. The fact that the market is maintaining touch with the Tenkan, that's good. That means it's stable. Price and time is stable. And I've said this before. See what happens when the market gets too far away from that Tenkan, and it gets a bit hot. It just likes to come back and maintain contact with it. And we've just sort of flattened out here, and we've done that. Now, the only thing I'd caution here is that it looks like we've got a bit of a triple top in here. Okay, so we just have to have a look at that. I just wonder if remember we had a bit of a Wyckoff distribution in here. I said the same thing's happening here. Maybe I'd have to have a closer look. But whether or not, I don't think this is ready to have its next little correction. And when I say correction, I mean small correction. Small correction, small correction. I don't know if it's ready cyclically to have another one yet. We'll have a look at that in a sec, but at a weekly basis, long-term stuff, there's nothing here that's untoward. You just stick with it, okay? Don't worry about anything else. You don't need to go any deeper than that. Just stay with it. The only thing I'd say of interest, you can see here that the Tenkan-sen's gone flat, and that you can even just see, because the Tenkan-sen is the midpoint of the last 9 weeks, okay, and it's just the market is currently sitting at that midpoint. So the deviation down, the deviation up, it's just sitting in the middle. So that's not necessarily a problem, but the median price is just not trending at the moment, because we had this big up. We've just had this little correction back down from this big up. It's fine. We're still a long way away from Kaijinsen and the cloud. There's nothing untoward here. You don't need to think about anything else, I don't think, at this point. Not this week anyway. I mean, the only other thing that looks good here is you can just see the swing structure that's in place, okay, and it's not failing. So there's no reason to expect that it's not going to keep going like that until it actually stops doing that, and it's not stopping doing that. Then I don't really see a problem. Okay, like the problem for me would be this: if it did that, okay, and it took out this low, but it's also a worry if the sun doesn't come up tomorrow. But we can't worry about it until it actually happens, and it's not happening. So, no, don't worry. Don't worry, be happy, as the song goes. So what's happening in the short term? Well, the one thing we've got to keep an eye on is this, right? Next Thursday, we've got earnings the earnings report coming out. So that could be quite interesting because going back to gaps, on the last earnings, that's when the last unfilled gap in the market was. Okay, so this gap here has never been filled. So whether or not we get another gap that doesn't get filled on these earnings, well, we'll have to wait and see. But certainly next Thursday, that'll be a day to pay attention. Okay, I think even if you're a long-term investor, that's still something, you pay attention to the earnings to see what the company's doing. And it's a quarterly thing. Just keep your eye on it. So previously we had this gap, and that got filled in. But and this is what I was talking about, just like short-term price structure. When you start to look, and this is exactly what I pointed out last time. When we looked at this gap, okay, what do we see? Well, all I saw was a confluence, a short-term confluence. We had these tops in here where we had this little distribution event. Then we had this gap. We filled it in, and we came down here. We came down in between the retracement zones, tested all this, and now we've come back up again. Now we've got another gap. So, what do we got? This one's a little bit different. There's one thing I'll just draw your attention to. It's kind of interesting. And so, it's fair to say all gaps aren't created equal. And I didn't want this whole video to be a rant and rave. It's not a rant and rave, but to be about gaps. But what was kind of interesting is this is the short sale volume, as I can see on TradingView. So I won't vouch for its validity, but I don't have any reason to believe that it's not correct. But you can see that there was some pretty heavy shorting on this gap, and then the market sort of corrected off. This time there hasn't been that same heavy shorting volume in there. So what that means, I don't know. But it was just interesting that this gap didn't get shorted as hard as this one, or at least as far as I can work out. Nonetheless, what do we have here? Okay, well, what would is this same sort of idea that this gap that we've got in here? I mean, look, it's almost closed anyway. But the point is that what I'm saying is, okay, you've got the gap. If we were closed here, then how would you sort that out? I mean, well, you can just see that we've got. It's a bit sloppy, isn't it? I mean, I wouldn't have said that's necessarily, even though you had this little sort of down gap there, but it got filled in. It didn't quite get filled in until we gapped through it. But the point being is, I guess you could say we had a little bit of resistance through here on this correction, and then we just gapped above it. But, the old thing, resistance becoming support. So you can sort of see how, resistance, gapped above. Are we going to come back now, retest this, fill this gap before we go on further? It's the same sort of thing that we had here. And it's kind of just how you would set up the short-term outlook. So again, irrelevant to long-term investors. This sort of stuff is irrelevant to you. But, I'm interested in the nuts and bolts. So let's just think about this gap. Okay, this gap was 1.97%. Okay, and these are all the gaps in that same time frame that have happened, that have been between 1 and 2% gaps. Okay, there's one that hasn't been filled yet, and that's way back in 2021. Okay, it's been open for 893 days, and the chances are it's not going to get filled anytime soon. The only other one, of course, is this current gap. But every one of the other gaps that we've had of this size has been filled. Now, once again, this may not be hugely relevant, but if the gap's still open after a day, what this is basically saying is there's a 2.9% chance that it's not going to get filled. So it's almost certainly going to get filled. But you can see as the longer that the gap stays open, the higher becomes the probability that it's not going to get filled. Okay, and when I say not going to get filled, it's not going to get filled basis our information that we've had since the start of 2020. Okay, if we took the whole price range and the whole history, then these odds would be greatly reduced because we know that so many of those gaps got filled. But using that sort of like, I guess it's pretty intuitive, right? That the longer a gap stays open, the less chance it's going to be that it gets filled. But look, the point remains that every single gap, except for this one back in 2021, that has been between 1 and 2% in Cameco since the start of 2020 has been filled. And they're the days that stayed open. So there was one here that took 144 days to fill. This one, it looks like it's going to get filled I'd guess on Monday we could see the S&P had a bit of a slide off into the close. But of course, we've got now these earnings coming up, and are we going to get another gap higher on earnings? So that remains to be seen. Of course, we'll see when this comes out. But nonetheless, I thought that was just kind of interesting. It's just like, because here's the thing: how would you use that? Well, I would suggest that just looking at this information, it would be a bad idea to chase gaps. Okay, it would be a bad idea to chase gaps, because the chances are that the gap's going to get filled in. Not necessarily, they don't all fill, but the odds are in your favour of waiting for that gap to get filled. If you want to go long, you can chase the gap, but you got to understand that there's a better than likely chance that the gap's going to get filled. So if you were short-term trading, well, I think putting a stop there would not be a good idea, because you know that there's a good chance that the market is going to find that level. So if you did chase in here, either you're out, or I wouldn't stop it here. I would probably only want to stop it probably down here, or even below that, because that becomes too obvious a target. But you get the point, right? Maybe you want to stop it out somewhere down here. I don't know. But the point is that you could use that information in short-term trading to know that would be a bad place to stop out, and that this is probably not the best place to be buying. A bit of patience, because there's a better than likely chance that this gets filled in, and if you're convinced it's going up, it's just a bit tactical, right? You can just use those statistics to go, well, there's a better than likely chance that this is going to get filled in and retest this, and there's a retracement, so blah blah blah. But that's how you just try to craft yourself a statistical edge. I mean, how do you think trading models are built? Statistical edges. That's how they're built. And so that's just a slight one that you might be able to use in your own short-term trading when you see a gap in the market. And remember, the gaps don't happen that often, but you just got to know that these gaps get filled in more likely than not, and they get filled in, usually within sort of 10 to 20 days at most. If they don't, then they're probably not going to get filled in. But if they're not going to get filled in 10 to 20 days, well, the market's probably way away from there anyway. There's probably something else going on. So that's why I would just say that if you want to chase something in like that, you might just, rather than buy it here, you might just want to give it a couple of days at least to see if it can fill in this gap. And then I would probably just suggest, well, if it doesn't fill in this gap and a few days goes by and it starts threatening the top, well, maybe then you get back in. But anyway, that's just me. But that's what I've found with these gaps, and that's how I've thought about it. So let's just move on from gaps. Anyway, this has run a bit longer than I wanted it to, so I'm probably not going to. I was going to do UR&M today as well, but I will just leave that. But I just wanted to have a look at these time cycles, because I have just ever so slightly adjusted the way I was looking at it, because the general thinking is that we get 2 to 5 cycles in an intermediate cycle, 2 to 5 daily cycles in an intermediate cycle, and I was just sort of struggling with this, but we did get the close below the 10 week. I've sort of referenced mine against some other sort of sources of people who are more knowledgeable about me than this. I'd sort of seen the market like thus and thought, I don't know, because this first cycle then becomes very short at 26 days. However, it does fit it fits the pattern, and it fits what other things I'm sort of seeing. Elliott wave-wise, just general fundamentals, the trends, that just doesn't look like any imminent chance of this coming off, sans some sort of black swan event. And if there is a black swan event, then nothing is going to warn you. That's why it's a black swan. So this would just look like the timing cycle. So we had this very short daily cycle 1 here at 26 days, and that, even though I've got these boxes, these are just averages. Okay, so just because something averages 50 doesn't mean it can't come in at 10, doesn't mean it can't come in at 90. It's just statistics, right? Things can deviate outside statistics. So this second cycle here, even though we did get below the 10 week, I think this looks more like a half cycle, okay, because you wouldn't expect an intermediate cycle to be that short. Maybe it turns out to be that, and it have to be readjusted, but I think as it sits, we've just had this half cycle high, this half cycle low. We have the inclining trend line now. So now it's just a question of, I think this becomes the timing around about the 1st of March. Now, interestingly, we've got the earnings coming in just very This is one standard deviation from the mean, but here we have the earnings coming in. Okay, so whether or not those earnings disappoint and that makes another cycle low, I don't know. But this would be the general time frame where I expect the next daily cycle low to come in. So the daily cycle low, of course, would just be the market going below the 10-day moving average and settling underneath this trend line. Once we get that, then we would go, okay, cycle 1, cycle 2, cycle 3, something like that. As long as we don't break this, we don't have a failed cycle. What are we on now? This is currently have a high on day 28. Yeah, I would think there's more just cyclically. You would expect that that's not going to be the daily cycle high, that we're going to have a bit more upside before we get the next correction. So that's kind of how I would think about it. Day 28, it feels a bit short, I think, to make a daily cycle high. We want this to be right translated. I think it'll be right translated, meaning that the high of the cycle is past the midpoint of the cycle in terms of time. So I would expect, I don't know when, of course, but I would expect that this is going to run a little bit further. This is short. This isn't. This is about medium. We almost need a longer cycle to balance out. You tend to find when you get these little short cycles that you'll get longer cycles as well. Now, this one was more or less in range, so I'd expect potentially a longer cycle, maybe like a 70 or 75 days or something like that, just to balance out this shorter 26-day one. Okay, it doesn't always happen, but that's just kind of, the market likes to balance itself out in terms of that. So that's just kind of how I look at these cycles. It looks pretty good. The fact that we've got what I think is an intermediate cycle low here. So these have been the intermediate cycle lows on the run up. You can just see as we just dip and settle below these 10-week moving average, and this is the other one. And even though we haven't really had a weekly close below the 10 weeks, so even though it's, there's some daily closes below it, we're looking for these weekly closes below there. So cycle, 1, 2, 3, 4. Maybe we just get one more. That could be another 6 months. Who knows? I would think that this is going to get above here, but only time will tell. We've got this triple top we just need to come in here and defeat. So I think that's where we said, look, I think I'll leave it there. I've done a bit of ranting and raving here this week, and it's probably just dragged on a bit longer than I want. So let's just pull it up there. Let's just wait for these earnings to go past in Cameco, and then we'll see what goes. So I hope you liked that video for something a bit different. Don't forget to hit like and subscribe if you did. And we will see you next week. Thanks for watching. Bye for now.